we're going to be handing the reins over to After, who will be discussing macroeconomic trends and its impact on gold. Most notably, what is the impact of the virus on gold? First and foremost, I would like to do a sound check. If you can hear me loud and clear, just type yes in the question box. All right, great. Thank you, Kaizen, Janin, Willie. Thank you. And that is going to be what After I'll be covering today. As you know, this live webinar is jointly organized with our friends from CME Group. We have Rachel Wong, who's a rep from CME Group, and she's in the house. And if you have questions pertaining to the exchange or the gold contracts that they have, you can direct them in the question box as well. All right, so After, if you're ready, I'm all set to hand the reins over to you. Without further ado, over to you.
Hi, Shri, can you hear me first?
I hear you loud and clear.
Okay, that's great. Okay, let's get it going. Macroeconomic trends and its impact of gold. I'm sure most of you looking at the screen would see the virus and the Dow, and of course, a chunk of gold. These two things has been actually, as you all know, a bit keeping the Shri, I can't move the slide to the next one. Sorry about this.
All right, so if it doesn't work, you just try the down arrow or the right arrow, see if that works for you.
Yeah, okay, yeah, it works now.
Sometimes it happens. Sorry about that.
Okay, no issues. Primarily, before we actually begin, we have the usual disclaimer. Most of what I'm going to say does not take into account any specific objectives or your financial situation or any particular needs of any particular person. Okay, let's go on to what I have to say today. We started 2020 on a very positive note, and if you remember, we had the trade agreement between the US and China completed as far as phase one was concerned, and we thought that the year would begin with a big bang. And yes, it did, but not the big bang that we actually wanted. We soon had a major world health crisis followed by an economic crisis. The central banks got involved. And of course, we come down to gold itself. Gold also was in many ways affected by COVID-19. So we come down to the themes that we have today. What makes gold still a safe haven asset? And recently, you know that market movements have been very volatile. We do have gold and stock indices moving in the same direction when they were not expected to. And the nextly, we look at the damage done by COVID-19 and why the central banks had to do what they wanted to do. And of course, my outlook for gold for 2020 and maybe the next half. We also covered the CME micro gold contract. Okay, let's look at gold that on the chart that we have since 1970, you find that gold have been steadily appreciating in price over the years, good returns. You probably might be wondering 1980, all right, this, if some of you might have remembered, this were the work of the Hunt brothers, where they cornered the silver market. And of course, gold got dragged up with it, up and then down. And then we have another blip in 2009 where we had the financial crisis, which actually, on hindsight, did quite a bit of gold because gold rallied quite a bit on the QEs that were introduced by central banks. And here we are now almost testing the highest. Narrowing it down, we had gold almost breaking 1900 an ounce, then dropping off to almost to below its marginal cost of production at the time, and then appreciating up again. And narrowing it still further down, all right? Although gold's movement has been within manageable levels, but what happened in March is something of a concern, or is it a concern? All right, we'll cover quite a bit of what actually happened in this blip here in March and why it happened. Okay, coming back to our old view of gold, what makes gold a strategic safe haven asset? Gold has many uses. It is used for investment, a reserve safe haven asset, for jewelry, and also in technology. Its attributes are that it's highly liquid and no one's liability. You don't have to worry about credit. And of course, it is a scarce metal. And for those have gold in their portfolio, these are the benefits that modern portfolio theory has for gold. It generates long-term returns. It mitigates losses in times of market stress. It is highly liquid, and then it provides overall portfolio performance. But recent volatile market movements have many questioning the reasoning behind the benefits of the portfolio theory. And there were many questions that were asked. Firstly, does gold meet the investment requirements? Does it provide safety, liquidity, and return? And during times of systematic stress, does it preserve capital? And we'll look at it also later. And does it help in the specific risk in a portfolio? But simply having safe assets is not good enough. We should be able to liquidate those assets during times of a financial stress. And of course, gold need to give a return as it's not interest bearing. We'll try and answer all these questions in this short webinar. Okay, let's look at gold per se, for instance. What exactly people keep golds for? Gold is yet a scarce market. It is actually a rare metal, and most of the gold that we have is in jewelry. About 47% of the world gold is in jewelry. Then we have the central banks that actually have about 17%, and of course we have bars, coins, and ETFs that has about 21% of the gold reserves. And we have proven reserves, and comparatively it occupies about 2.6 Olympic swimming pools, and this is what a percent of an average height would look like in this cube of gold. Okay, next thing we will look at gold derivatives, which most of us are keen on. Right? If you look at the gold derivatives that is in the sphere of gold, I would say. They occupy, like options and futures occupy a small percentage of what we have in the world of gold. We have investments, they occupy quite a big chunk, and of course, fabricated gold that is even bigger. Then we have, let's look at financial gold in terms of major, how does it compare with major financial assets? If you look at it, of course, we have the S&P index, which is huge in terms of size, and gold is, financial gold is right in the middle here. Okay, and who buys jewelry? All right, the biggest buyers are, of course, the Indians. Jewelry, the thing about jewelry is this: jewelry demand. When the price of gold falls, jewelry demands goes up, and the other way around. So currently, with the high price of gold comparatively, jewelry demand will not actually help support the market itself. We have to look at other drivers of gold, especially because the other thing is that India, as you know, is also having the same problems that the rest of the world is having. A lot of their jewelry shops are under lockdown also, so we would not get much help from there. Okay, let's look at gold, India's gold imports, and see how important is India in the world of gold. If you look at the colored pattern up there, that is the 5-year range, and the 5-year average is this square boxed. The colored line is 2019, and here we are today, quite stagnant for February and March. Not much help from gold on the demand side of the story. But next, we have to look at central banks and gold itself. Of course, central banks have a lot of other functions, but they're important in gold because they hold huge chunks of gold. Gold is deep and liquid, and central banks do want to hold gold instead of US dollars and other assets. Primarily, the central banks actually hold about 17% of above ground stocks, together with all the banks in the world, the IMF and the Bank of International Settlements. Why gold instead of any other precious metal? Gold is, you could say, safe and highly liquid, and it provides returns too. Okay, next thing, why the central bank has got involved in gold. If for those who have been trading gold for a long time, you remember that in the late 1990s, gold bulls always feared the central banks, because the central banks could come in and sell huge amount of golds that they have. But in 1999, right, they formed an agreement called the Central Bank Gold Agreement, limiting themselves from selling gold. We have 15 of the large banks who got together and said, why are we actually killing the gold market? Okay, we had 2004, we had first 5 years, then second, and then the third, and then the fifth itself. And you find that sales by central banks in this agreement has come down lower and lower. But they stopped the agreement in 2019, but they didn't want to extend it anymore. But key to it is also the announcement that they made when they agreed that they should not sell gold unless it's really necessary. They confirmed that gold remains an important element of monetary reserves, and none of them has indicated that they have plans to sell significant amount of gold. Right, the central bank's agreement are valid now, also because a lot of banks, as we know, have been involved in QEs, they need cash, right? But yet, based on that, we know that they will not sell gold because the amount of gold that they have is a little bit less than what they should have. Normally, it's around 14% average that they have the share of gold reserve of total reserves, but now most of it at the end of 2019 we still have 12%. And of course, the Bank of Poland cited very strong reasons for holding gold itself. And if you look at the graph itself, you'll find that sales by central banks have actually almost diminished on a net basis in 2011, and 2019 they were net purchases of gold. The next thing we look at an hypothetical pension fund portfolio. Most of fund managers believe that they need to hold about 2 to 10% of gold. It varies according to their portfolio, the risk that it faced in terms of utility, how illiquid it is, and how concentrated the assets are. But the risk-adjusted returns, most of us believe, is good to the addition of gold. Gold also is a highly liquid market. We have gold trading more than most financial assets. Of course, we have the JGBs, we have the treasuries, and the S&P. Then comes gold. Okay, the funny thing about gold now is that we find that gold's correlation work for investors, not only during period of turmoil, but it also now has a positive correlation with stocks and some of the risk assets. So it works as a double benefit, both as an investment and a luxury good. And of course, gold supports income growth. Let's look at how gold correlation with stocks help your portfolio in good and bad times. You find that this one is when the S&P move up by 2 standard deviation, we find that the correlation of gold is better than commodities. But however, when S&P move up and down 2 standard deviations, we find a basket of commodities doing better. And when the S&P is down by 2 standard deviations, we have gold in an inverse relationship with stocks. So it helps. The return over the years, these 2 charts provide a graphic view of the Dow Jones compared with gold. We have the blue line, Dow Jones over the past 30 years, and we have gold. Of course, gold did not do as well as stocks over the years, but on the last 5 years, we find the results quite mixed, where currently now we have gold doing much better than stocks. And of course, this year, we all know how assets perform. Gold was #1 asset for the 30-year US Treasury bond. The rest of the instruments did not do as well as gold. And of course, this is where crude oil comes in. Okay, next thing we need to know briefly is the ratio of how and gold and the S&P is related. How much gold can you need to buy the S&P 500? over the years, this is what we have over the charts, and lately we find that gold is expensive as compared to the S&P 500. So the question comes in, is gold correlated or not? It often depends on time horizon and the data used. A lot of analysts we find that are quite differing in their opinions. The top analysis from Mirachon in 2015 from the Market Realist, and the bottom paper is from the International Review of Financial Analysis 2015. The top one says now correlation with the S&P 500 over the last 45 years averages 0, whereas the bottom analysis from the International Review states that it does help in a portfolio. Okay, but come to our own experience. What concerns us is the gold recent sell-off that scared everybody, right from the middle of March to somewhere to the last week of March. We have gold almost selling off very hard with 5 million futures trading volume. And also there was a huge spike in volatility. Gold dropped about 12% as compared with 8% with the Treasury inflated protected TIPS ETF of the US. Okay, but what we found out from the sell-off is that gold is moving in real rates. They mirror the move in real rates. The drop in gold prices is similar to the move in real rates. Okay, we find here the US TIPS, and this is the US TIPS, and this is the sell down in gold itself. And both of them actually have recovered after the sell-off. The good thing about the sell-off was it woke the central banks up. Having learned the lessons from 2008 during the financial crisis, we find the central banks actually coming in, and here what we have an asset appreciation of the central bank. We have been flat relatively over the last year, and this is what it has appreciated into. So we can say that gold is a function of rate rails, the US dollar, commodities, and of course risk. We can look at it as a store of value. Okay, if you look at the chart, you find that it's a change of fair value of gold to one standard deviation change in, say, the VIX. If we find gold changing 2%, when the VIX change one standard deviation. When we have real rates coming down, we find a similar movement in gold itself. And of course, we have here the Goldman Sachs Commodity Index and the US dollar. So we can briefly say that gold volatility is a function of mostly the real interest rates, US dollar, risk, and then commodities. Okay, and primarily what we can conclude is, rather I can conclude that 80% of the variation in weekly gold prices can come from primarily movement in real US, rather real rates. Okay, and lately, of course, this has been a concern. Gold volatility tend to follow in other markets. we find that gold volatility actually track G10 currencies, especially the Japanese yen and the Swiss franc, but not commodities like oil and natural gas. And most of the gold volatility is confined to more to paper gold assets. Here, if you look at the chart itself, this is where we have gold, and we have the WTI, the 10-year swap option, among others. And we find that primarily during a period like this, most assets move about the same time as each other. Okay, gold interacts in different ways. All right, now we find that what concerns us is this positive correlation with stock indices for gold. Over the years, you find that the colored bars are all the positive correlation. We have negative and positive correlation, but currently what we are having here is a positive correlation with stocks. This is maybe due to the lockdowns that we are all experiencing. Okay, next thing we need just understand why central banks reacted, pumping so much liquidity into the markets, which had been good for gold. Global stocks and jobs, of course, take a hit. You find here the US jobless claims as compared to the rest of the weeks in the year. And travel among, of course, we know that flights will be or have been worse hit, and primarily they will continue to be hit. I would say it's not easy to keep safe distanced in a plane. It's going to work badly on airlines. Then we have factories in China closing down. If you look at the charts itself, the graphs itself, we find that Chinese industrial production is down. Currently, hopefully, it's now starting to pick up. Then car sales are down quite heavily in China. And of course, on top of that, we have the oil war perpetrated when the OPEC agreement failed recently. We have crude oil falling down right down to, this is for the Brent crude, for the WTI, it went into minus. It's something that is totally new for traders. And of course, we had OECD dropping their downgrades for growth forecast. If you look at China, this is China 2019. This is what they have forecasted for 2020. And of course, the rest of the world, not a pretty picture. Okay, the IMF also have come up with their world growth projections. Global economy 2020 down by -3. Advanced economies down -6.1. The EM markets and developing economies -1 in 2020. Then they come up with later by the regions itself. We all know everything is down in 2020, but they have a little bit of confidence in emerging and developing Asia. They feel that China would be the first to pick up and drag growth. China is also important as far as gold is concerned because it is also another large importer of gold. Okay, we look at how significant and financial easing around the world has caused so much of I would say, alleviating the pain that is actually otherwise would have been caused by COVID-19. US GDP is down 30% year to year in the second quarter. Japan is down, and then we have China also reporting a contraction in the first quarter. And of course, because of all these projections, we have the central banks coming in to increase their balance sheet. Most of them have been quite stable, around 25% of the country's GDP. And all these things that the central banks are doing are actually good for gold, especially when currencies are involved that are not backed by gold, they are backed by paper. Their value would slowly decrease. Next, we look at what I've been saying, the central banks' assets, which is ballooned. We'll see later why this ballooning of central bank assets is good for gold. And here we are talking about the various central banks. We have the RBI, the Fed, the Reserve Bank of Australia, and the Bank of Canada. All of them practically, as the headline says, in the race to increase their balance sheet and save domestic assets. Okay, the ECB is not left behind. We have the ECB also coming up with their own asset buying programs. They are buying assets which previously they said they would not do it. And here we have gold also being one of the assets that they would increasingly buy. And of course, governments have also come in. We have fiscal spending across economies, which is nothing short of taking your breath away. We have the UK, Spain, and so on and so forth, right? Surprisingly, Korea did not spend that much. And of course, we have Italy spending much less as compared to a share of their GDP. Next, this one is quite a nice chart that I like. As central banks double their balance sheet as a percentage of their GDP, gold prices normally tend to move higher. So if you look at aggregate of, say, December 2000, and over the years, we find that as the central bank balance sheet increases, so does the price of gold. Right, this is this aggregate of the central bank, and now it has actually surpassed its ratio of what it had previously for gold itself. Okay, besides the central bank, right, you know the jewelry demand is down, but what is propping up gold also is investment demand. Okay, if we look at the chart based from 2005 onwards, we find that the investment demand is quite correlated to the price of gold itself. So we can safely say that quite a bit of buying of gold would come from investment demand. Next, we have gold ETPs and ETFs, exchange traded products primarily, and most of it are backed by physical gold. We find that if we look at the price of gold as compared with the number of holdings, we find as the price increases, investment demand also increased. So let's go on to our outlook for the second half of this year. We know that gold prices have performed well in this recent period. over the past 15 months, all right, we had a rally of 10% since the Fed Reserve started their U-turn in monetary policy. Right, they started the ball rolling, and other central banks followed and gold had a good performance also. Of course, it has not been a straight line. We did have a sell-off in March that scared everybody, but one needs to understand that every asset, including real interest rates, dropped during the same period. So the swing in gold prices was just mirroring the move in real interest rates. And of course, we do have strong headwinds. Of course, the US dollar is still strong. Financial market volatility is a little bit reduced, right? And of course, reduced jewelry demand from India and China. But rates in the US and the economies are, the G10s are likely to be below zero for a very long time. Central banks try and keep inflation back. Beyond rates, we have the banks buying more and more to increase their balance sheets or the official reserves. This will be one of the key determinants of gold prices. And of course, the more central banks buy and more their fiscal deficits is going to deface fiat currencies even more. So given all these parameters and factors, I'm quite bullish about gold. For the second half, I have a target of 2,000 per ounce. And I would say it would continue beyond the first half of 2001 to 2,200 an ounce. I can't really say much beyond that because economic growth will start to pick up and it will be a different ball game. And of course, for those who have been trading futures, recently there was some, I wouldn't say exactly a controversy, but some concern over physical market dislocations at the delivery of the last gold contract. Just a brief gold. COMEX gold mostly delivered into New York, but quite a bit of the gold comes from London and Switzerland. However, due to quite a bit of COVID kind of logistic issues, there were some problems ferrying the gold to New York. However, the Chicago Mercantile Exchange got into action and tweak their contracts, and everything was well and good. And if you look at this chart itself, you find that the concern was we have inventories and a short open interest that is so much higher than the inventories of all, and this is the thing that actually triggered the huge concern. But now everything is well and good. Okay, let's go on to specifics where we have the new CME micro gold contract and the specifications for the COMEX gold futures. The CME micro gold contract is a smaller contract as compared to the traditional 100 ounces, is 10 troy ounce. The price quotation is per troy ounce, but same. But the minimum fluctuation is where's my mouse? Okay, 0.1 troy ounce, which is equivalent to $1, whereas this one, the movement, a tick movement will give you $10. The listed months about the same, but do note that both are deliverable contracts. And for those who are starting off to look at an investment in gold and find the volatility in gold a bit scary, I would say scary, but of some concern, you can start with the CME micro gold contract. The micro gold contract is also highly liquid. And if you look at the bid and offer spreads, is just as good as the big contract. The benchmark June, this was taken from yesterday about the same time. You find that the spread is about a 20-cent spread, whereas we have the micro gold about a 10-cent spread. Pretty good. Okay, that's all that I have to say. Shri, could we take the Q&A?
Yes, we can. We have a whole bunch of questions waiting for you, After. The first one is the question on everyone's lips right now. After the lift off of the lockdown period, is gold still a good investment?
Okay, what's going to happen primarily when the lockdown is eased, right? Of course, there will be a lot of pent-up pressure. We'll find a lot of manufacturing, everything coming online. Of course, stocks have already begun to pick up, especially in the US itself. And gold will, of course, not be a favorite among a lot of investors. But let's not forget that in an epidemic like this, one that looks like it's not going to go away, a third wave might just come in, and we'll be back to maybe not where we started, but somewhere there.
All right. So our next question is.
Okay.
Next question is, what are the main drivers for gold to go from a high of about 1920 in September 2011 to about a low of 1046 in December 2015?
Could we have the question again, Sri? I need the dates.
Sure, no worries. So it's 1920 in September 11. I think we all know what happened. And 1046 in December 2015. What happened in December 2015? And it had a price of 10.
Okay, let me just go and just move to the chart itself, and then it will be easier for me to explain. Okay, let me get the date correct. We have, what was the dates again, Shri? Shri, could we have the dates until 2015?
Sure. The first one is September 11. September 2011. That's 1920. The second one is 2015. The price was 1046.
Okay, 2015. Here, what we have is the Fed announced that they going to stop the QEs. They find that the QEs was having not the effect. If we all know that QE3, QE4 did not have the intended effect that they actually wanted. So the Fed actually, the time was before Yellen, that they're going to actually do away with the QEs. They're not affecting, and of course, a lot of investors felt that okay, it's not going to work out for gold, and of course, gold started to drop. And what was the other date? Chris, sorry, Shri, could you
Sorry, the other date was September 2011. The high was 1920.
September 2011. All right, this is where where they felt that gold had gone high enough. We had a significant amount of investors cashing in from gold itself. A lot of other factors came in. Real interest rates actually start to come down here, and of course gold followed suit. So it is one of those things that real interest rates have this grip on gold itself. Okay.
All right. Okay. For the next question, okay, how does gold and silver perform in a deflationary period?
All right. We need to understand that one, gold is primarily a precious metal, although it has its use in technology. It is not so much as silver itself. Silver is more of an industrial metal than gold itself. In a deflationary environment where if manufacturing picks up, right, there will be a demand for silver other than its store of value, but not so much of gold, other things being equal itself. And for those who follow the gold to silver ratio, you find that it's primarily at historical levels. Primarily this is because all the quantitative easing has benefited gold much more than silver itself. The drop in GDPs have had silver investors worried because silver is more of an industrial metal than gold. Yeah, next.
All right, we have a very interesting question from Mr. Alvin. His question is, with the world in turmoil and many central banks printing a whole lot of money, will gold go back to the days where it was backed by gold?
It's quite a rhetorical question. If I was a central banker, I wouldn't have. Primarily because for every dollar I print, I need a backup for gold. It's quite a difficult. That's why they went off the standard. Primarily because central banks find that printing money, if you are on the gold standard, is not so easy. Right? You need backups. And but I would love them to be on the gold standard again. It would really push gold to I don't know what heights. It's something that is quite unimaginable.
Sounds like the gold analyst has his own supply of gold somewhere at home in the basement. Well, our next question from HSO. Has gold's correlation with equities over 25 years averaged 0? Can we safely ignore what gold will do when equities go up or down?
Primarily, sometimes on a day-to-day basis, it's difficult to tell, right? It depends on each particular situation, right? Take, for example, in March itself, right? Priced equities came down, real interest rates came down. Okay, gold also follows suit. So sometimes it's a judgment call in this case itself. one has to look at all other parameters that are affecting gold. The sell down was, of course, quite heavy, but it did woke central banks up. So one has to look at each particular situation to see whether gold would be correlated to equities or maybe it has a mind of its own.
Okay. After, would you be able to explain how the gold price is determined? Maybe how a gold price is determined in a CME a micro gold futures contract.
I think I'll leave this question to the CME.
Rachel, this is your cue.
Hi,
can you hear us, Rachel?
Yes, can you guys hear me?
Yes, yes we can.
Okay, so pretty much the CME COMEX gold price is based on the pretty much the market price, how and when the market participants has been trading. So it has certain correlation with the physical gold market, but after all, for CME we are an exchange, so it's an open, transparent marketplace for all the investors globally to express their view on gold and gold market. So it depends on the traders and investors and how to reflect their view on the gold market and the gold outlook.
All right, thank you so much, Rachel. After I have next question for you. So till the end of 2020, will the USD remain strong? If so, will it hamper gold's advance?
Okay, another rhetorical question. Okay, in times of crisis, in times when there's a lot of uncertainty around, of course, a lot of investors would want to put their money into gold. They would want to put money into the US dollar. And of course, the other savings like the Japanese yen and the Swiss franc is there also. But if you look around the world itself, you find that the best performing economy, right? Take COVID-19 out, we find that the best performing economy in the world is still the US. And one would put money into the US dollar. One would also want to put money into gold itself, because both are often safe havens, especially in the times of uncertainty and in times of crisis. So I would say in this environment like this, both often complement each other rather than supplement each other.
Okay, so for the next question, what is actually the difference in gold CFD and the CME gold futures contract?
Different, Chris. Sorry, Sri, you're a bit soft. Between which two?
Oh, sorry. Yeah. So the comparison between gold CFD and CME gold futures.
A CFD is another derivative compared to futures. CFDs is, as you know, is cash for difference. If you compare it with a futures contract, and Rachel will agree with me that it is traded by the exchange itself, whereas contracts for differences are primarily have different principles. CFDs is also another instrument, and we want to look at which one is better. It's tough to say. One has to look at one's own investment objective, which one suits him best. They're just both different type of derivatives that are in the market.
So this is Rachel from CME. So maybe I can explain a bit more, add a bit more color in that. So pretty much CFD is actually not a listed product. So it's the product offered and created by the CFD brokers or CFD providers. And so the bid and offer might vary because it will be controlled by the broker. Well, when we talk about COMEX gold futures, any listed futures and options, so it's been listed is listed in the exchange. So it's the price for the futures and options will be very, very transparent, because no matter if you're traders here in Asia or you're traders in the UK or US, you are all looking at the same price. And so the price is actually, like I've mentioned earlier, depends on all the investors and traders view. So there's no any intervention into the price in the contract and product itself. So it's a lot more transparent and fair to investors. So that's actually the main difference. And then the CFDs, you may you may have some counterparty risk because it's the product by the broker. So the price will be a bit different. Depends on which broker that you use, and and that's why we will always encourage investors globally to trade listed products like futures and options instead of CFD, because you will have a bit more security, and the product itself would be a bit more is a lot more fair and transparent.
All right, thank you so much. And thank you for being a wonderful audience. There were so many questions today, and I'm afraid that we can't address them all live. Rest assured, we will address all your questions in our follow-up email or a follow-up call. All right, thank you for being such a wonderful audience, and do look out for our next live webinar coming your way very soon. All right, meanwhile, stay safe and take care, everybody. Bye-bye.